for registered investment advisors. Irv, I'm going to kick it off with you. How do RIAs find analytics that are objective and robust?
Okay, well, I've been lucky enough to be invited to different conferences. I was Barron's top advisor, and in conjunction with that, I do go to the Barron's roundtable meetings and also some of the trade meetings relative to the advisory groups like TD or whatever. So, oftentimes, I'll spend a lot of that time meeting with other RIAs, and just determining best practices. There's a number of workshops that usually show up where you can demo and then follow up with that. And then really I was lucky enough to meet Marc Chaikin and be introduced to Chaikin Analytics, and the fact that with options play integrated into that it makes my life so much easier on a regular basis.
Right, so Marc, I can imagine that you've seen in the analytics business that it has certainly evolved, particularly over this decade.
We have, and we identified early on that advisors have a big problem, which is time, and there's too much information to process. So we've focused our software development on the advisor space, and particular emphasis on tools that help advisors do two things. A, process information more quickly so it becomes a productivity tool, but also to help them bring in new accounts, because that, in essence, is what the advisor needs to do.
Well, what are some of the factors that are important when determining key characteristics of stocks, because there is so much data out there now?
Well, because of that, I developed a multi-factor model called the Chaikin Power Gauge rating that drew on 30 years of working with successful buy-side portfolio managers. And in doing that, really zeroed in on what really good active managers look at. So cash flow is one thing. Warren Buffett's been all over the airways this morning. What does he look at? Free cash flow. Also, valuation metrics like price to sales. You don't want to pay too much for a dollar of revenue. And then we zero in on what we call the experts. What are the analysts doing and saying about a stock? What are the insiders doing? How do the short sellers view a stock? These are factors that aren't normally accessible to advisors or individuals in an efficient way. So when we combine them into this multi-factor model, we really bring in everything that you need to know and synthesize it down to a rating on a stock that we call a Chaikin Power Gauge.
Well, why is it also important to incorporate fundamental analysis into your work as an RIA?
I think it's important. Well, we're regulated by the SEC, so it's important to document a repeatable process. Something that's documented a repeatable process in the sense of what are you looking for, what are the factors related to how you're choosing a particular stock, or even ETF, because Chaikin Analytics will also look at the ETF and ETF sectors as well. So, for us to effectively do our job, we want to take a look at what the analytics are, what the analysts say, really seek out objectivity. I think that's a problem, to be honest with you. You have a lot of analysts that are working for Wall Street. They're either underwriting a particular stock, or there may be a particular bias relative to that. So finding the objectivity, I think, is key. It's a very dynamic market, and we need a tool that's going to allow us to be dynamic and be responsive relative to client needs. And that's the key to it, is, again, being able to show that process, show the due diligence, and then using it, both on the buy and sell side for the benefit of the client.
Well, speaking of the client, how important is it for an RIA to understand data and analytics? If I'm a client, what am I looking for in an RIA?
For the most part, I think you need to look for somebody who's done, besides becoming an RIA, look for somebody who's done due process and looked at advanced studies towards designation. So I'm a CFP, CHFC, CLU, CRPS, AEP. And
your business card must look interesting.
Yeah, that and my last name having every letter in the alphabet, it's a long business card. But aside from that, we have a big responsibility. People come to us, they don't want to worry about their money. They want to put their kids to college. They want to retire with dignity. That's a big job.
Right.
And you've got to take arrogance out of the equation, which is not exactly easy in this industry, but you do, and take a look at what skills you need to master and hone to the benefit of the client.
Right.
Clients don't know yet what they should be looking for, and they should. If you're going to a doctor, you want to go to a doctor, not somebody who's operating out of an alley or whatever. So that's what's key to this, I believe.
All right, well, Marc, let's talk about some strategy here, and what are some of the pros and the cons of owning certain concentrations of stocks or certain concentrations of sectors relative to broad-based S&P basket?
Well, I think people are becoming more knowledgeable that market cap weighted indices actually have some risk to them, particularly in the large cap space where 6 or 7 stocks dominate the indices. So we really look from a macro view, top down. I want to know what sectors are likely to do well, and we use sort of the power gauge for the stocks within every sector to know where the potential is. So right now the defensive sectors in a rising interest rate environment don't look good. So I think it's important for both the advisor and the client to have some confidence in a set of tools that can help them understand the products that they're buying, where they might have inherent risk that's not clear, and then as an alternative find ways to improve returns, in essence generate alpha by zeroing in on sectors where there's opportunity. Right now it's technology, finance, industrials, the sort of cyclical sectors that do well in a robust economy. So the more knowledgeable the advisor is, the better the client is going to be served.
So do you think these strategies and philosophies can coexist with each other? Traditional fundamental analysis, technical analysis, and data analytics, can they all coexist together?
They can, and what we've learned is that the advisors who use this multidisciplined approach, which Irv does, which is a combination of fundamentals and technicals, ETFs and stocks, actually do better for their clients.
All right, and Irv, I'll ask you the same question as well. Do you find that allowing these to coexist makes a more complete management practice?
It does. I mean, again, the argument of passive versus active, or trend versus, fundamental, to me, if you're not taking a step back and looking at it holistically, and incorporating both sides of the equation or all sides of the equation, I think you're making a mistake relative to the client's success. And what we're seeing right now, the volatility, you've got to even take a couple steps back and incorporate additional asset classes aside from traditional stocks and whatever. Alternative investments and things like that are going to start to play a more active role in really being able to preserve and benefit the clients. So yeah, they definitely coexist.
All right, well, thank you very much both for joining us at MarketSite. And traders and RIAs, thank you for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.